All right, let's jump right into it. So much action this week. It's unbelievable. With the biggest action of all, of course, this disclaimer. Love it, live it. Let's take a look at the S&P to start with. First of all, you can see the whole week was really, it started out very, very weak, but really it ended up quite neutral. Now, neutral in the context of a very bullish purple predictor. So this looks like we've put in a nice little bottom in the market. Now we really need to get confirmation, so I am being a little bit aggressive here, but conditions are good for a rally. We'll get to the seasonality in a second. Now, the other thing here is here's the in the upper right-hand corner, we can see the little red line shows that it's coming down, which shows that selling pressure is abating. It's really coming down pretty strongly. But buying pressure is not really entering into the market yet. And the ADX, which is the black line, is suggesting that it's still in a bear market. So this is not a good-looking chart here. The S&P, better. Dow, not so hot. The Nasdaq, strong purple predictor, good close to the week, but still premature. Even though I was sounded a little bullish with the S&P, we have to allow the market to develop as it will. Now, the seasonality indicator held up. Purple predictor is bullish. So unless we get below 148, it's still bullish seasonality. Now, I want you to think about that. So bullish seasonality, even though we've had a decline in the market from, let's say, 160 to 150, for argument's sake, just to pick a number, that's still not enough to turn the seasonality bearish or neutral. You see, we should be rallying for another several weeks. And then we should start to see the market start to dribble lower. Not plunge-o-rama, but dribble-o-rama. All right? Kind of a choppy, messy, kind of a boring market. And that should end in the fall, let's say September, October. So I think the best thing is really to assume that this seasonality will continue. So in other words, the strength that we saw, or let's say the neutrality and the late week strength, is kind of a last gasp move up to April highs. Now the yield curve continues to remain a negative on the market, a negative in terms of capping any gains. So it's going to be hard. Now remember, at the beginning of the year, we had the trifecta, and that has been almost 80–85% chance that the year will end up strong. So that doesn't mean it'll be strong through the spring and summer, but it does mean we're going to have a very, very good fall. Okay, now this is a big important thing that did happen. Asset allocation. We talked a lot about this last week, and we're continuing to see the same story. So what we're seeing is we're just seeing money go out of the stock market and into the bond market. And that's where the selling has come in. But at the same time, we're seeing the purple predictor hold up, which means that smart money is coming into the stock market in order to take advantage of these bargains that the dip has created. So smart money's coming in, but money is flowing out into bonds. So the smart money is rotating into stocks, but most money is rotating into bonds. So you're seeing a deeper understanding of what's really going on here, and they're fighting to a draw, the smart money versus the money going into bonds. The stock market risk-dicator also came down. So what this means is that we're starting to see money go into defensive sectors. Now that's usually consumer staples and utilities. So it's going out of the sexy, Nasdaq technology type stocks, and it's moving into the low, boring, but stable stocks like consumer staples, food companies, utility companies, that kind of thing. So they're finally, remember last week I was quite surprised that the risk-dicator went up. I thought it should be going down. Well, of course, this week it came down. Now, global shares, boring, who cares? Now, remember what I just said, that money was flowing out of the stock market into the bond market. Well, we can simply see what's happening here, an acceleration of what was a very sluggish bull move is now accelerating to the upside. So the way I look at this is from a purely technical point of view, that the market was struggling higher and it was just really a bear market rally. But now with the acceleration, I think we've embarked on a new bull market that's going to take us up towards the old highs, 126, 127. So that's a pretty big move in the bond market. Let's take a look at our key factors. Very interesting. So up at the top is the green line. That's the actual treasury yield. So you can see it's coming down. Bonds go up. That means yields go down. Now the gold line is gold and it's still neutral, but that blue line, that's German 10-year yields and it's collapsing. That's the most important factor affecting the bond market right now, and it's collapsing. Then we get to the actual chart itself. That's the CRB index, and it's neutral as well. So the pressure's still coming from our fundamental factors for a down move in the bond market. The dollar, like I say, I've really not been very interested here. I am interested in dollar yen, so fully paid up members, we'll talk about that when we get into the fully paid up section. But the dollar itself is just going sideways, which therefore means gold is going sideways. So we had a nice rally there. We got up towards the high end of the range. Let's take a look at our factors. This is, you can see I rated the top two factors as neutral. The bottom one, which I had ranked as bullish, came down very sharply and put a lot of pressure on the gold market. So at this point, I think the best thing is to really not do anything in gold. Oil, as I mentioned, I'm getting more and more bulled up about the oil market, and we're going to struggle here, obviously, at the 67 level. We're not going to be in an explosive bull market to the upside by any means. There's just too much supply out there. But nonetheless, I think we'll see up and down, but with an upward bias. Finally, Bitcoin, it fell off as I was suggesting. And remember that what I said is that I think we should get back down to the 5,000 level. Let's call it, the previous lows there where the purple line is. I think that's about 5,500. We definitely should get down to that 5,500 level. I've also mentioned, though, that there's a very good chance we're going to drop below that because about $5,000 is the cost of production for one Bitcoin, and we need to choke off the production of Bitcoins in order to get a bull market back in force again. Now, the bull market's going to come up here pretty soon. I put that down red line, that trend line going down. That would be the trigger to get back long in Bitcoin. Okay, freebies, that's what I got for you today. Listen, make sure you check in again next week because we're at this transition zone. Very important you check in. Fully paid up members, hang in there for just a second.